Welcome everyone to the Bloomberg Intelligence US Industrials Analyst Call. It is October the 18th, 2023, and it is 11 a.m. Eastern Time. My name is Mustafa Okur, and I cover electrical and flow control equipment at Bloomberg Intelligence.
I'm Karen Ubelhard. I cover large cap industrials and rental equipment.
And I'm Chris Cellino. I cover U.S. machinery.
Chris, I would like to start with you since you already had some results this season. Who did you have report so far, and what were your main takeaways?
Yeah, we had Fastenal report last week. Short cycle industrial distributor, touch a lot of manufacturing and industrial end markets. So it's a good, real-time look on what's going on with the industrial economy. Not a ton of forward visibility, but more of a kind of a pulse of what has happened over the past month or two, I'd say. And results, were largely in line with expectations. The surprise there was more on the gross margin line. Price cost came in a little bit better than expected, and mixed headwinds were not as severe as anticipated. So that's where the slight EPS beat came from. But in terms of the end markets, it's kind of been status quo relative to last quarter. Broadly speaking, industrial economy continues to soften. I think on the positive side, we're not seeing any, further degradation in the markets. It just continues to be more of this gradual moderation. And I'd actually say their September monthly sales figures actually saw a slight acceleration. It seems to be probably more of an easy comp than an actual uptick in activity. But I think that's probably one positive anecdote. They continue to highlight aerospace and defense as one of the stronger markets out there. And interestingly enough, while it was very recent, they did call out the transportation market as one market that they're starting to see, not necessarily green shoots, but there's some positive momentum starting to build there. And I think that generally aligns with what we're seeing in the freight markets, and recovery in some of the rates, as some of those declines start to narrow. So I think that's one really to watch as we move into next year. Obviously, truck market expected to be down, but probably looking at more of a modest downturn versus prior cycles. And then the other company I'd highlight, we got results from Volvo earlier this morning. Truck demand continues to be very resilient this year. A lot of pent-up demand coming out of all the supply chain issues. Pricing, again, remarkably strong. The setup into next year, more challenging, but they put out a 2024 outlook for the market, expecting North America Class 8 trucks to be down roughly 12%, which kind of aligns with our down 15% view for next year. Europe is going to be down 15%. Construction equipment broadly softer across most regions, but kind of in that mid-single digit, low single digit type range is how they're thinking about the markets evolving into next year.
Thank you. And Chris, the busy season really kicks off next week. Who and what are you going to be watching?
A lot. I would say, I think our expectations going into really the heart of earnings season for a lot of the machinery guys is we think we've already hit peak in most of the machinery markets. So I think you're broadly looking at a decelerating top line and earnings growth. I think consensus expectations are for roughly high single digit, low double digit earnings growth on average in 3Q. That's relative to, 25, 30% what we saw in 2Q. And I think a lot of the share performance recently, if you looked at the last 3 months, machinery companies have broadly underperformed the market. So I don't think expectations are terribly high, but any miss is certainly going to be punished, as many fear we're at a cycle peak. I'd expect better performance from some of the construction names, particularly like an Oshkosh or a Terex. They were a little bit later sorting through some of the supply issues. So I think there's probably more earnings potential there just from a comp perspective. And I think you're probably looking at ag being towards the bottom end of the range and softer growth maybe kind of low single digit, mid single digit, and then, trucks and, rest of construction equipment somewhere kind of in between there.
Tough comps are definitely a problem in my space too. ABB also reported today, a major electrical equipment company covered by our European colleague, and the stock is down more than 6% after the discrete automation and robotics unit posted a 27% order decline. Now, there is more China exposure there, which is not doing well, but still the read across is negative for companies like Cognex, Rockwell, and Emerson, maybe less so for Emerson due to their process automation exposure and high energy exposure, which is doing much better. That company is covered by Karen, but before we get into the multis, Karen, let's continue with machinery and talk about rental companies. What do you expect to see in that sector in 3Q?
The rental companies are one of the biggest beneficiaries of the federal money that is flowing. They're all North America, so it's really what's happening in the U.S. And it's not just the federal money; it's the mega projects, the onshoring projects, and this is a multi-year event. Started really, I guess, end of last year. The money started to flow in infrastructure, but it built this year. And then there's the IRA and chips and other things that are going to help the rental guys. They have had revenue growth in the 25, 35% for a string of quarters now. And they're again going to have growth of 15 to 30% depending on the company, and again against 25 to 35% growth a year ago. So the top line is extremely strong. If they had more equipment, the top line would be even stronger. So that from a top line perspective is going to be very, very strong. There will be some slight margin impact because they are now back to refreshing their fleets. When things were tight over the last 2 years, they did not sell equipment. So used equipment sales were down. This year, they're selling a lot more equipment because they're buying a lot more equipment and they're trying to get back to normal purchasing patterns. So there'll be a little noise from the used equipment side, but overall the margins will be good and the outlook is also good. There are some concerns about commercial construction that comes up in every conversation, and I believe the rentals will outrun the recession if we have it this year because the money that's flowing in from other sources is A, unprecedented, and B, larger than anything that could happen to the commercial markets.
And do you see risks to execution there, potentially from supply chain issues like labor shortages? I still have some pockets like transformers and aerospace where shortages continue to linger. Do you see that for rental equipment at all? Is that a factor for their execution in this quarter?
Certain sectors, aerospace, there is a difficulty getting labor, difficulty getting parts as well. That's the one where the supply chain issues are still not great. In terms of labor in the rental companies, none of them really say it's that bad, but they did have to pay up to get people and keep people. So that definitely, wages have definitely been a factor, but don't really, what I hear is causing the shortages is the fact that they don't have enough equipment, not that they don't have enough people. But there are other areas where labor is still a little tight, and the primary focus is really on the aerospace side, which is probably going to keep going for a while.
Likewise, I'm hearing about aerospace too. And the other thing I'm hearing is a shortage of skilled labor, electricians, plumbers, in general, tradesmen.
Yes. The HVAC guys say, yeah, out in the field, there's shortages. Their labor internally seems to be okay, except they're having to pay up.
A similar message on labor cost came from Eaton recently, and it seems like the large companies that we cover, they have their house mostly in order, but it is labor or component shortages that could affect them in the supply chain that seems to be the problem. Chris, turning back to you, which sectors do you see the biggest risks and opportunities within your coverage? And if you could share some of your early thoughts on Q4 and 2024, please.
Yeah, I guess I'll probably reiterate what I mentioned earlier. Probably, construction equipment on the aerial side, probably the strongest growth outlook as we look ahead to this quarter, with ag, trailing still positive growth. And as we kind of look ahead to 4Q and to 2024. I think there's going to be a big focus in on where inventory levels are going to shake out. We continue to see both new and used inventories really climb universally across the sector. So that's one area that I would watch. But as we think about next year, you probably still see the biggest downside risk on the truck side. Just given the short cycle nature, that tends to be a little bit more of a volatile market. And like I mentioned, I think we're thinking, Class 8 volume down about 15% next year. Ag, we're thinking on the large ag side, probably down mid-single digits, and then construction probably somewhere flattish, plus or minus a couple points. So that's kind of how we see the rest of the year and early look at 2024 shaking out.
And Karen, both in your coverage as well as mine, resi and consumer exposed revenue has been quite weak this year. Bearing that in mind, directionally, do you see any risks to consensus estimates or potential upgrades this year?
I think you're seeing the second half of this year and even into next year, the estimates are pretty moderate. I think that it's built into expectations that things get slower in across most sectors. So I don't think that there's a lot of risk on big estimate cuts, but I think people are being actually pretty conservative. The ones that do have the most risk, but again, people are anticipating declines, are those that are exposed to consumer markets like 3M and ITW. And ITW's two biggest consumer exposed markets, construction and specialty products, they've been down low to mid double digit for a couple quarters now, and that's going to still continue. And 3M seeing softness in electronics and anything tied to consumer, and they have a broad-based product offering. So, across consumer, industrials, et cetera. So those are the two where we are seeing some weakness. 3M's done a big cost reduction program, so their margins have held up. ITW's margins usually hold up. They're very good at execution, but that's where you'll see the softness in the top line. The other one that's going to be interesting is Parker Hannifin. Their mix has changed a lot. They're now 30% aerospace, which of course will do if in line to better than expected, but they still have 70% tied to industrial production. They've been trying to build out more long cycle businesses within that industrial exposure, but it's still pretty ISM related. So we've seen orders turn negative in North America and the US. North America and Europe, their two largest markets, but they've still been able to hit numbers because they are doing extremely well on margins, and they have, they have the Meggitt integration that's going to help, because they've got a lot of opportunity to improve margins there. But people will look at those orders. If they deteriorate a lot, that will have repercussions probably for them and also for other companies with short cycle exposure.
Now, there is one giant multi-industrial that we have not talked about today, and that is Honeywell. Karen, what do you think about their upcoming earnings? And also, now that they have resegmented and renamed their segments, do you think they will go down Emerson's path and break up the company?
On the earnings potential, they have about 35% is aerospace. So that's going to continue to look really good. On the other end, they have an automation piece that's like warehouse automation and some process controls and things like that. But that has been weak for a while, largely because of the warehouse side. But the margins there are up 700 points year over year because they've done a lot to get that business resized. They're now starting to see some aftermarket business. It's a business that they acquired, and it was very OEM oriented. Their parts business was quite small. They've built out a lot of original equipment is in the field now, and they're starting to see some parts. But so that'll be a margin story, but volumes will be down. That's expected. And the other two businesses, one is energy related, so that should be okay. And the other one is home building controls. So that's sort of low single digit growth. And so it'll generally be, Honeywell's pattern is beat a little, raise a little, beat a little, raise a little. And they used to get credit for that, but they're not anymore because they're being left at the gate because it's kind of a there's no catalysts at Honeywell, and it's actually been an underperformer. Thus, the resegmentation and the renaming of segments. And basically what they did is take out process controls and put it in with the other automation businesses and rename everything to have mega trend names like energy, climate solutions, hot names to try to, what are the same businesses. Now, will they break up? I don't see any signs of them being interested in doing that. They still like the diversification model. That's also hurting them right now because it's out of favor. But I think for now, they will sell around the margin, but I don't think they're going to do any big breakups. They are probably going to do something on the acquisition side. Finally, they've been sitting on $10 to $13 billion for years. The prior CEO was very hesitant to do any acquisitions. He did some small tech deals. They have a new CEO. I think he's more interested in doing some bolt-ons. So the portfolio may change by adding, but not subtracting.
Yes, the slow and steady model of diverse multis definitely doesn't seem to be in vogue these days. We have just topped 15 minutes, so we will leave it at that for now. We will reconvene after the earnings during the second week of November. Until then, everyone take care, stay safe.